What's up, everybody? Ryan Garland here, founder and chairman of Paradyme, and we have Mike Reveley, our CEO, today in this under the same roof,
Under the same
which is
roof,
very rare because we're always scattered throughout the country and
rural
meeting
Tennessee.
always. Yep, we're here in East Tennessee where it's really really cold, and I know for those of you that are in Havasu, it is actually just as cold because I think it was 41 degrees this morning, and I think I looked at it and it was about 42 or 43. So it's really, really similar, just probably a little bit more of a bite out there.
Mhm.
But I do want to get right to it here, guys. I think it's really important that we try to deliver value as soon as possible. One being that, a lot of people are seeing just a lot of noise on social media, the news, and a lot of people I think are just kind of tired of trying to understand where the world's going. And we are too, in many ways. And I think what we're trying to do is just lean into our understanding and kind of our track record and really kind of, the standard practices of where money goes, that's where the world's going, kind of thing. You probably have heard me say that a million times on other podcasts, but that's really kind of the nature of this is we want to share with you guys kind of what we're seeing, how to navigate these waters and just kind of let us brain dump on you. And hopefully you guys get some takeaways out of it. So, with that said, I want to say thank you guys all for joining us today. Again, Mike, it's always a pleasure to have him here because he's just a wealth of knowledge. Without trying to sell him, Mr. Wall Street, he's the guy who is the bookworm back there watching what all the big boys are doing, and so he has a lot of value. And I'm actually going to hand over the mic to him here in a second, just because he is so smart and just has again a lot of knowledge, and that's ultimately why we brought him on with Paradyme's platform. So, with that said, we are going to talk about stocks, bonds, alternative assets. Obviously, that's within the real estate sector, but there's also oil and gas, crypto, and so forth. We're going to talk heavily on health and wellness just because the largest generation, which is baby boomers, are moving into more of a frail component. And ultimately, what we want to do is try to touch on where, kind of the big pharma and where a lot of money is being spent in AI and technology and so forth on that side. And then ultimately, because we are the real estate gurus, we are going to talk on real estate. So, Mike, if you don't mind, my friend, do you want to go ahead and take off
Sure.
on stocks?
Yeah, I think before we do that, maybe for those people that saw it, and probably most people haven't, but we did a big write up on the Security Income Fund for Q3. We had a bang up quarter there, and that was really post election, right? Where we began to think about what this landscape really looks like post election, but also how we got here.
Yep.
Right? What these there's major tectonic shifts really in what's happening on the political side and within the country and how we're organizing our economy potentially. So we took sort of a 40, 50, 60-year sort of journey through the economic and political landscape. And really and I was doing that just sort of prepare myself for what we'd expect post Trump over the next, 4, 8, 10, 12, whatever, many years, this shift will last because political shifts in the US tend not to be 4-year shifts. They tend to be longer
Mm-hmm.
shifts. So when we did that, I really went back to World War II. I'm going to take it all the way back. Actually, I went back to World War One, but what I really was struck by is how blessed the U.S. is,
Mm-hmm.
and in many many different ways. And the first is, look, post World War II, especially, we went through these World War One, World War II incidents, but the U.S. was basically in a perfect position because our manufacturing base, our economies basically thrived during those years, right? So the devastation in Europe, the devastation in Asia ultimately led to a manufacturing boom in the U.S. We sort of led that, right? And we rebuilt Europe, we rebuilt Asia, and that led to this amazing sort of landscape of very high economic growth, low inflation, and we moved from a period of debt to GDP after World War II of like 120% of GDP down to about 40% of GDP, right? So all that was basically coming out of World War II and finding ourselves in this amazing trade surplus with the rest of the world. Now we're in the opposite position today, right? We're in similar, and our debt to GDP is about 120, 130%. So the question is, how do we navigate that landscape for what's happening now? I sort of took that analysis of the post World War II, and there were certain things that came out of that shift, especially my career in Wall Street began in the 1980s, and really coming out of that, there was something called the Chicago School of Economics, which basically said we're going to take Adam Smith's principles of free market policies, and we're going to go on steroids. We're going to basically deregulate the banks. We're going to try to come up with a smaller government footprint on the U.S. economy, and we're really going to emphasize, free markets, right? And this was about 1970, 1980, right? And we had two leaders. We had Reagan, we had Thatcher, US and UK, which sort of took that and with Wall Street, because Wall Street was the one financing this, remember, essentially we took this idea of freeing up the US economy from sort of overburdensome government. And that led to a boon. It led to a boon in the US economy, the UK economy, the global economy, and it also led to this movement where the banks were sort of freed up.
And that's what you're seeing right now as far as Trump's policy and trying to deregulate so many different, let's just call it bodies within inside the government.
Yeah, we're going back to that. We're sort of moving back to that policy, but it was important because it did lead to certain things, right? This idea of the Chicago School of Economics said, let's effectively reorder balance sheets in a way that makes the entity more profitable. And that led to what we saw really in the 2000s. It did lead to these platform companies that got developed in the 2000s. A platform company basically said, we're going to offshore our manufacturing, right? We're going to take everything that's capital intensive and has a lot of labor, and we're going to offshore it, right? Because if there's a downturn in the economy, we don't want to have to lay off our employees. We don't have to get stuck with basically creating factories which are now shuttered, which we've seen in the U.S., right? The Rust Belt experience we had in the U.S. were really major shifts and caused tremendous demographic problems in the U.S. for sure. So the idea was, if we can offshore all that stuff to Asia, and this is when China came onto the scene basically in the 1970s and 1980s through the WTO, and we were able now to offshore a lot of that stuff off to Asia in particular. So it created these companies that basically design it. Take Apple, for instance. They design in the US, they manufacture in China. So their highest value add is basically designing their products, right? So, and the smallest part of that profitability chain is the manufacturing of the actual product itself. So that all works, and it's tremendous in terms of its return on capital and therefore its impact to the stock price. And Apple's, I think, the largest market cap stock in the world. So it has amazing implications for shareholder value, right? But it has downsides, right? Because the labor is now you're not manufacturing in the US, and that's the big trend that came out of that. I sort of labeled it externalities. It's like these are issues that come up because of the way our economy is now structured, right? So moving what would be manufacturing jobs off to Asia made sense for the company, but doesn't make sense for the US. And, coming back to today, and what we're seeing is this idea that, do we need to reshore our manufacturing? And what impact is that going to have on stocks, on bonds, on government deficits, on labor costs, et cetera? And we're going to go into that. We're going to find out that, I think, over the next, 3, 4, 5 years, right? So
let me make sure we touch on this. This is something you actually did, though.
Yeah.
You brought a property out of Australia. Did you move them to Canada, then back into US? How did you move it?
I did. We
Right.
moved a company out of Australia into Canada, but we also took advantage of companies here in the US and brought them into Australia and brought them public there. So capital goes to where it's well treated, for sure, and where it's cheaper to operate. And coming out of that, so where are we in this whole? And I think when the Trump phenomenon, started feeding itself into the U.S. economy, what are the implications for that? And that does have implications for real estate, for stocks, for bonds, for generally all asset classes, right? So, without getting into what I think from a valuation standpoint, because if you just sort of focus on stocks for a moment, It's very hard. I mean, I'm sort of the person, given my background, that I say, look, do I have information that the market doesn't have, and therefore, do I have a better feeling for valuation than the overall market? I think the overall market, 9 times out of 10 or 99 times out of 100, is going to have more information than Mike Reveley. So valuations are pretty much cooked into the stock price. It's not 100%. We don't have 100% efficient markets, but for stocks, what they want is they want certainty, right? They don't like wars. They don't like changing, certainly increase in tax regimes. They don't like taxation of capital. They want low taxes and free markets, and less uncertainty as possible. And we're in an environment right now for stocks which has been really interesting, right? You had 2022 stocks were down about 19%. They rebounded in 23. I think they were up 20 to 22% in 23 and 24. So far, they're up like 24%, right? And a lot of that recent move has been a continuation of these big trends, but it also, I think, incorporated this idea that there's going to be a shift in the political landscape from what was potentially taxing capital gains at a higher rate, taxing personal income at a higher rate, taxing income and asset valuations that haven't been monetized, which was a ridiculous idea. But we went from that to a more pro-business landscape, potentially with the Trump administration coming in. So for stocks, it's less about valuation. I think it's more about broadening out the participation of the number of stocks that are rising in valuation, right? We had this idea that there was, magnificent 7 stocks. I wrote about this multiple times. It's like the valuation of these 7 stocks is amazing, but the idea that the S&P 500 is really dependent upon 4, 5, 6, or 7 stocks for its entire move, which it was, needs to change. We can't be that. We have to have a shift to a broadening out in terms of the overall performance of the market and getting away from these 7 stocks. Not that is going to happen overnight, but I think with the Trump administration and reshoring manufacturing, it's going to basically push the returns to companies that haven't really participated over the last couple of years.
And you're going to see, I think, a lot of, and this was something I was going to touch on later, but you're starting to see a lot of diversification. So people are seeing a lot of, like a bull run right now. They're really enjoying these increases on the returns, but they know that it does have a shelf life. So what's happening is people are going, look, I've made a lot of money. I'm happy with the type of returns that we made, but I want to start diversifying a little bit. And as things start settling in or shifting, we want to go to smaller operators or smaller companies, or allow other smaller companies to participate in these type of investments. So I think what you're going to see is just this landscape of more diversification, but really honing in on certain aspects that the economy is going to start shining on, like oil and gas, is a big push right now, as you guys can imagine. So it's things like that. Real estate, you kind of can't go wrong with real estate, because a lot of people are also nervous simply because when you have, this much, let's say, political fight battle, it's the uncertainty that gets people anxious. So, people just want something that can be consistent, that they can rely on, that they can reach out and touch a lot. And really the best way is that diversification model. So, I'll hand it back over to you, but that's really what's happening.
I think that's exactly right. And investors have the ability to diversify, in this environment. We're blessed with that.
Yeah.
Right. We can go in alternatives. You can go on, your favorite platform, whether it's Schwab or Interactive Brokers or any number, and basically, get a sector or get exposure to alternative asset that you couldn't do 5 or 10 years ago.
And if you think about it's kind of cool to think about that actually more off topic, which I like to do that a lot, very often. But the amount of data and information that's coming out, that, think about data nowadays than you did 20 years ago. You can get data at the tip of your fingers. There's so much information out there with a lot of really good technology and AI to scrub and scrape other data points to then hone down on what is going on in that asset or that investment. And I think that's what we're trying to accomplish, is try to provide that information for people to have, a better understanding of what they're getting themselves into.
Yeah.
And that's what I think investors or investments and fund managers are really starting to do, is produce this a plethora of education so people can really better off understand it, especially if they want to get into it and don't know anything about it, but also, really know what they're getting themselves into, because there's so many investors that I know call me and go, well, I didn't know I was getting myself into that particular investment with that person or what have you. And those are the things that we want to try to do, is provide that education, when people are getting into whatever the investments are, stocks, bonds, mutual funds, doesn't matter. Just here's information for you to really, understand it. And that's what's happening overall.
Well, I think that's been the major transition, right? During my early career at Wall Street had the information.
Yeah.
That was its edge. It had the informational edge that would then share with certain people, large investors primarily. By the time it got down to the individual investor, the values had already moved.
Mhm.
So the individual investors were used basically to take out the large institutional investors. They were selling while the retail was buying.
Right.
That was how Wall Street basically made its money. Now, with the advent of AI and all sorts of other independent data sources, you're doing effectively what Wall Street analysts were doing. That was their career, right? So talking to the CFOs and sort of getting quote unquote insider information, digesting it and getting it off to their clients. Not so much anymore, right? Not so much anymore. That now, I think if you're a savvy investor, you can get that pretty much on your own. There's always an informational advantage, obviously, but for the most part, that's been taken out of the market, and that's had real big ramifications for investors.
And then you have the other kind of, I would say, derogatory side of it, where you have a lot of information that is floating out there that's incorrect. And then that, that are trying to drive a certain that person into a certain direction, whoever's viewing that data, right? That's kind of the point to this whole thing, is just to kind of share with you guys, again, there's a very common theme with how the economy has been run and how policy can easily give you a better blueprint, or let's say a yellow brick road, to understand which way the market's going. And that's ultimately what people want to know, is like, who can I surround myself around that has been getting it right for a long period of time? So that way, in a market like this, everything sounds great, but we know that, one missile away, we maybe go to war, right? So what's that mean though? And at the end of the day, you want to be able to have the education and be around the people that are prepared for that are kind of going, it's not a matter of if, it's when, and it's better to be safe than sorry, right? And that's really kind of the continued kind of part of this. But anyways, you want to go ahead and push over to Bond?
Yeah, I think I'll say one thing about that before we move on, is I think, Trump has been sort of seen as sort of a chaos agent. The interesting thing about it, I think, is just the opposite, right? So I think what Trump is basically signaling is, we want to get out of the wars. We basically want to reduce essentially those externalities, those question marks that will impact the U.S. economy. So higher taxes to lower taxes, getting out of the endless wars, trying to find a solution to Ukraine, the Middle East, et cetera. And then also dealing with the potential problems of what we're seeing in the U.S., right? With, go to bonds now. I mean, this will take us right to bonds, which is, how do we finance our deficits, right? So, and this is the big question mark. There's been this recent discussion about, what is Trump going to put in tariffs, across the board, and what would the impact that be on inflation? Versus the other side of this is, he's also put in place a real focused policy on reducing government spending, reducing our deficits. And if he's able to do that, second thing, then I think this idea of, the bond markets are always focused on that. It's like, how are we going to finance our deficits? And interest rates, to a good part, are reflective of that, certainly on the back end of the curve. And if he's able to make a dent in that, and a real dent, and address it for the first time in 40 years, then the impact of bonds is almost immeasurable, right? We have a pretty flat curve, right? Right now, interest rates are about 4.5% right across, from T-bills to 30-year bonds, and it really doesn't reflect what the Federal Reserve seems to be on this path of lowering interest rates, because we're not certain as to how those dynamics are going to play out. Are we going to have tariffs? What's the impact to the economy? Are we going to have to finance larger deficits? So the bond market is waiting, I think, for direction from the Trump administration. It's got direction in terms of the Fed, but that, are tariffs inflationary or not? I personally, I don't think they are. I mean, we can go into a big discussion about tariffs, and I'm happy to do that. But essentially, what that means, what a tariff is doing basically is leveling out labor costs across the globe, right? And this is what we've seen. This is going back to that platform company. When you offshore labor and production, what you're doing is you're going to an area where you have cheap labor costs, right? That's what you're doing. And when you do that, you're taking jobs away from the U.S. You're moving them to Asia and elsewhere. What you're hoping in the U.S. is you have this shifting landscape to, you become programmers, you become coders, you become marketing people. So your jobs shift from manufacturing to something else. But that doesn't always happen, and so you need to have this balanced economy, and we've probably shifted too far, right? So the idea of tariffs would be to sort of normalize that labor differential, and then bring some of the critical industries back to the U.S. I mean, it's hard to believe that from the U.S. perspectives that we have a pharmaceutical industry that relies on China to provide our most of our drugs to the U.S., or producing military arsenals offshore. We're not doing it here, right? So there is a need to do that, but generally, if you look at it, that's all inflationary, right? So the cost of doing business is increasing because you're reshoring. Now, the offset to that, of course, is we can automate, right? You look at factories today, and a lot of that is basically being automated. It doesn't mean there aren't good jobs at those factories for some of the lesser trained labor, but you're not using the amount of labor inputs that you would use in China to produce in the U.S. because you're going to be focusing on automation, right?
And what happens too on the manufacturing side? Let's just use, because where my head's going.
Yeah,
I think what happens is to back into the tariffs. Really, the idea too behind a lot of that is, and he said, level out the labor field. It's true, because it's going to help produce more jobs here, right? It'll incentivize the business owners to hire here. What you're going to see is that because of technology and a lot of, let's just say, automation that's going into a lot of these jobs, you're going to have higher paid jobs because you have more management level positions, a little more skilled labor. And then some of the downline, really the idea is to try to drive more of a volume-based business. So ultimately, if you need laborers and you have a lot of technology involved, you really need to have a volume-based business. Well, the way to create a volume-based business is to try to lower your corporate tax. Inflation is a big deal, and so on and so forth. So what's going to happen is you'll see a much more consistent, I'd say, economic growth, or maybe some stability that we're all really hoping for. And that really is going to help everything across the board from every metric in every asset class that we're talking about. So those are the things that, again, that are very, very important, because it's going to help your brother, your sister, your friends, your family, all that, be able to have jobs and not rely on you to borrow money, because we all have those family members. And it's not a bad thing. I've been one. I need money. In 2008, that was a rough one. But at the end of the day, those are the things that are really I think you're going to end up seeing, assuming as far as what's been going on currently, and it looks like on the track that we're on continues. So
yeah, but
it's really important.
Staying on bonds for a moment, because it's really going to be central. So interest rates, to a great extent, have a large impact on the valuations in all asset classes, whether it's stocks or whether it's commodities or whether it's alternative assets. The interest rate landscape in the U.S. is extremely important, right? So we've gone through this incredible period of interest rate volatility with the Fed raising rates, and the yield curves going inverted, indicating a slowdown. And we've been in this really uncertain interest rate environment, but generally, higher yields, right? So now the yield curve has gone from an inverted yield curve where long end rates, 30-year rates, are below short rates, which is unusual, right? You would expect that you'd be, in most periods, just the opposite, with longer rates being high. You're being compensated for putting your money to work for 30 years. Now we have a flat yield curve. To me, that's like a reset. The bond market is resetting Where are we going to go? Are we going to go to this inversion where you've got that inverted yield curve, or are we going to go to something that looks like a more normal yield curve? My bet is we go to a more normal yield curve with overall interest rates being lower. I think that's my bet at this point. And I'm not sure that's a consensus bet, but that would be my bet. I think the market is too focused on tariffs. It's thinking that inflation is going to be higher, and it's discounting the ability of this new administration, I think, to lower government spending, because we haven't seen it. You haven't seen the first Trump administration. If you look at the first, it's like a tale of two administrations, right? The first half and then COVID in the second half. So I think from an administrative standpoint, he's putting all his chips in to his ability to lower government spending, and he's got to get that through Congress. But he has basically all branches of Congress right now. So he does have, and this is an administration, because of that, he has the real ability to push through some real changes at the government level, right? And it's going to have to be across the board, defense and discretionary spending, because interest rates and the cost of financing the government is basically chewing up the majority of our of our budget. So he has to do it. I think he'll be successful. So my bet is we're going to have the Fed continue to lower rates, inflation coming down a little bit. Sure, tariffs will be put in place, but there'll be tactical, strategic tariffs, not across the board. If I'm wrong on that, they across the board, that'll have different implications. But for us, as a real estate focus, it's going to have a real large implication in terms of where real estate goes from here, right? Because big picture, we're 5 to 7 million, homes short in this country. Right?
Yeah, we're always going to have, I don't see us being able to get enough materials with enough labor force and enough skilled, we were just talking to, Tiffany, one of our investor relations team members. Her husband's a superintendent, and I think they just announced that they're short like 6,000 superintendents across the country.
Yeah.
So at the end of the day, there's going to be issues on the housing market no matter what. Therefore, I think you're going to see housing costs stay high. I don't think you're going to see them come down. Really, the number one indicator is going to be affordability before they come down. But because our cost of construction is still high, you still are getting incentives from builders and developers from jurisdictions like the city and the county and state, even in regards to impact fees and taxes and so forth, and trying to, in the opportunity zones, that was a big deal, last 6 years, incentivizing developers to come into areas that need to be renovated and clean up due to crime and what have you. And then they get tax benefits from long-term capital gain tax benefits. But I think at the end of the day, you're going to see a lot of residential, I think you're going to see the rates come down a little bit. You're going to see a very consistent and steady development process. I think one of the big issues that for me as a developer, as for us, we are worried about material bottlenecks on certain trades like switchgear and electrical components and so forth. That is starting to loosen up. But those are the things that we have to stay on the forefront. But again, if we stop relying on those certain trade and bring more of that manufacturing back into the U.S., then those bottlenecks and materials won't be a problem. So we can actually increase and see a velocity or increase in velocity of delivering real estate units, and therefore that's when the market would actually come down. Once we have a plethora of units being dumped into the market. So we can tee off on that.
We're going to tee up on that in a little bit.
But yeah, that is something. So go ahead, Mike.
Yeah, I think from alternative assets, it sort of goes back to that discussion. We have interest rates, one, will determine the value of commodities for sure. But the regulatory framework in this country will also determine the availability of the natural resources. We are blessed. This is another where the U.S. is blessed with, we are a commodity powerhouse. But to a certain extent, we've been limited in terms of taking those commodities out of the ground, right? Oil and gas, gold, all sorts of rare earth metals that are being used in production of all sorts of things, including solar, right? So, the ability to, if Trump is able to reduce some of this, it's going to have massive impacts in terms of the amount of commodities that not only the companies that are taking them out, they'll have an increase in valuation, but we're going to free that up for, global consumption and consumption here in the U.S. So commodities are starting to be back in vogue, in my opinion, right? So I think that's going to be a really interesting period. And if the Trump administration is smart, and I'm not going to throw anything out there that's too new, but to a great extent, we are blessed. We have more oil and gas in Saudi Arabia. We probably have more commodities, hard commodities like gold, silver, copper. All that can be used to finance our debt. If it's done smartly. I mean, you got countries like Norway which set up basically an asset manager. They're basically a big hedge fund. They essentially they take a share of all the commodities that come out of the Black Sea and other parts, and the government gets that, and they reduce their government debt, and then they also invest it globally, right? The U.S. is taking a little bit different approach, but what Trump has said is we're going to open up lands, we're going to decrease regulation, we're going to go after oil and gas, we're going to go after other commodities. We do that in a intentional way. I think people are undervaluing the impact of that on even things like our deficit.
Yeah.
And the amount of government bonds we have outstanding and the ability to retire those. So we're getting farther ahead of ourselves in terms of whether or not he's able to accomplish that. But if you think in those terms, if you think of the U.S. as a balance sheet, not just the liabilities, right? Our liabilities are our government debt, but you think of the balance sheet. Well, the balance sheet is unlike any other balance sheet in the world. So this idea that somehow we're not able to finance our debt, that's ridiculous. We can finance our debt under any circumstances. The issue is, can you access the asset side of your balance sheet, right, to the benefit of that?
How do you get a value add to bring down that deficit?
Correct.
And bring down that debt. And
Right.
and we've had it forever, but we just got to tap into it and start playing the cards a little smarter.
Yeah, I think that's right.
Sure.
And in terms of, I think people, and I have conversations about crypto all the time because we're, as a developer, we've got our funds on the platform, our developments, and their investments, just like any other investment would be for our clients. And I hear people, crypto this, crypto that, and I view crypto, it's an alternative asset for sure. It's sort of the new gold in a way. But it's also playing on a fear. And that fear is that there's going to be a real change in, the U.S. defaulting on its debt, or the dollar not becoming the reserve currency, or general, economic chaos. And therefore, I want to be in this sort of bank in the clouds. I want to be in crypto. And I think there's truth in that to some extent, but I think for me, it's overvalued. So crypto is at call it 100,000, right? Bitcoin's at 100,000 right now. And I was having a conversation with somebody. I said, look, okay, so it's a bit of a greater fool thing because the valuation is just what somebody is willing to pay for it after you bought it, right? So that's either up or down. It's been on this upward trend because basically the view is that Trump is going to be crypto friendly and they're going to have an SEC, which is going to be more crypto friendly. And we think that's true. But I don't think that necessarily is a Bitcoin story as much as it is, the underlying drivers of this, and be able to tokenize things and use tokens basically to buy and sell the Empire State Building or, whatever, right? You basically are tokenizing assets and then selling those tokens as investment opportunities.
And it's really hard because the U.S. and the SEC hasn't really been able to, there's not a big regulatory body that's overseeing that because, what the problem is, you're not able to tax it until you pull it personally, right? Where if you're an operator, meaning you're someone who owns a lot of crypto and you're in, let's just say, multiple investments. It's nice because you can just rotate your capital into different investments. You can convert U.S. currency into your crypto, and then you can invest it, right? And that's a great thing. But what happens when you take it back? Well, you're going to be taxed just like anything else on income, right? The idea is to be able to shift that into certain asset classes, like real estate, as an example, to be able to now diversify your capital outside of certain coins and get into these asset classes and not have an issue. And again, move it from that asset class after your capital gains or your gains back into that, like an IRA would, and you're not getting taxed until you pull it personally. And that's actually that's what's happening right now. In fact, what'll happen, and this is really, I think, the only thing that we have to focus on, or the SEC is going to really spend energy on, is kind of the money laundering side from, people abroad wanting to invest into U.S. real estate or U.S. investments, and they're just moving it through crypto, but there's no real governing body to verify the background of that particular investor. Where by law, when an investor comes and makes an investment, we have to do a background check on them, make sure they're a U.S. citizen. Even if they're not, that's fine. There's just different documents. We still have to verify them. Well, think about bigger numbers and people coming out of other countries, that are moving money into certain assets. And so that's the governing part of it that I think will loosen up, but there still has to be some fine line of being able to verify those investments and investors. And what's happening, what you're seeing is that, and what you're going to see from us is we're going to start opening that, because we have an online investment portal where people can actually go on. So we're very on the forefront of what's happening and utilizing AI and technology. But at the end of the day, you're going to see crypto start being a bigger deal in the investment sector, because in essence, you can, buy and trade and sell and invest and move it all back through your crypto wallet and not have to pay taxes on it until you pull it personally. And it's very similar to an IRA. So I think you're going to see that start becoming a bigger play. But whoever's in crypto now or decides to invest in crypto, they can get their hands on more investments here coming soon. So that's the growth pattern that we're seeing through crypto. And again, by loosening certain guidelines and government oversight.
Yeah, I think the SEC is going to get its arm around that. Like
it's not that difficult.
People worry about it, but I read something a couple weeks ago, and it said, and I'm not sure this was about 10 or 12 years ago now, but 84% of all the U.S. currency that's been issued, we don't know where it is.
No.
Right. So what does that go to? That goes to black market, that, and we're worried about that sort of aspect in terms of crypto, but it's the same thing. You've got to deal with those issues, whether it's, dollars used for, drug trade or money laundering or nefarious, black market activity, and crypto doing the same thing. So I think from a regulatory standpoint, they'll get their arms around that, because they'll have to be sufficient disclosure, because we have to, as a fund, we have to know who our investors are, right? They're if we're going to have investors overseas or even in the U.S., there needs to be background checks when they're coming into the fund, and we'll get there as an entity. But it also will open up, I think, and we're going to have a discussion on this in terms of our Reg A, is whether or not we open up a series under our Reg A just for crypto investors that want to come through crypto into one of our projects, the Barn Cave projects or something
and
else.
We have the ability to do that. The SEC has actually approved that. So we actually can do it. But there is still that governing body. We have to disclose every investor that makes the investment to the SEC and what those numbers are.
Yep. But I think it's going to be easier. The SEC has been pretty reluctant in granting, approval for that. That's been the issue. So I think that, from best I can tell, that I think the Trump administration, given a change at the head of the SEC, will make that something that will be a priority. So what does that do? That frees up global capital, right? So that capital now gets moving, and guess what? The U.S. at the end of the day is a safe haven. It will always be a safe haven, Mike. Unless I'm envisioning things that are outside my scope, the U.S. is going to be a safe haven. Well,
you're still seeing a bunch of investment coming into the U.S. I mean, it's happening. EB5 has been a big conversation piece lately. People coming into the U.S. and still getting debt, but they're looking for the green card in essence, right?
Correct.
So there's a lot of that going on right now.
Yeah, exactly. So
cool. All
probably. Right. We can probably spend a bunch of time on that, but moving on.
I'll keep talking.
Yeah, I know. We haven't got to real estate yet, really. So.
I know. Health and wellness. Okay, I'll tee off on health and wellness. So this is kind of something that's near and dear to our heart, but I think really the big focus is again kind of going back to Trump's new policies and kind of how he's pushing it in RFK, kind of taking over the what's that body that he's taking over?
Health and Human Services, HHS,
FDA, whatever it is. Yeah. So the bottom line is, and this is something we've already been seeing going on, and with all the problems that have come out with vaccines and people dying and passing away and so forth, and just kind of how problematic that whole thing has been. What you're seeing is that a lot of going back to the old school, physicians are telling their patients, hey, go back to the old school way of, dieting right and working out, right? So you're going to see more of a holistic approach, and that has been a big movement already. And the health and wellness game is, again, going back to the beginning of this webinar, was the fastest growing industry, and it's simply because baby boomers are the largest generation. As they become more frail, they need more healthcare. So with the derogatory issues with inside the, let's just say, pharmaceutical companies and all the problems that's gone on there, I think people are just becoming more cautious of what they're putting in their body and they're eating and what have you. And the data is really coming out. And now people are becoming, I know I am. I mean, we are our kids. I mean, I think everybody's the same way, but you're going to see an increase in the health and wellness space. So anything that you guys are looking at as far as investments into, whether it's an operating gym or if it's by the way, that was a little bit of an under thing, but we're building a gym, by the way. So, but a gym, or, anything that has to do with supplements, anything that's organic, a lot of organic farming. You're seeing even the world shifting when it comes to pesticides, kind of going more organic. There's just a lot of movement going on there. And I think health and wellness is going to be on the forefront all the way through even 2030, going into 2040. So, the health and wellness space is going to continue to just absolutely skyrocket. So,
Well, I think it has to, because at the end of the day, it's going to bankrupt the U.S. government.
yeah.
Because, essentially the health, and this is amazing, couple of stats. So the life expectancy in the U.S. is falling.
Mm-hmm.
That's the first
Getting
time
shorter.
it's ever happened. And that's because of all the disease and probably related to obesity and our food chain.
Mhm.
So that's an amazing stat to me. And the second part of this is, and I'm not sure if it's the MD Anderson building, but there used to be only one building. Obviously, it's with, if you're military, you can see license plate from outer space, but there used to be like one building that you could see in the U.S., and that was basically, I think it was the MD Anderson building in Texas. It was so large that you can see the Great Wall of China, and you can see like a hospital in the U.S. I mean, we shouldn't be seeing hospitals as being our large landmarks in the U.S.
True.
So yeah, getting control of childhood diseases, the obesity, all that is would otherwise bankrupt our medical system.
Mm-hmm.
So having that change of focus, I think will be incredibly important, not only for the health of the citizens of this country, but from a government spending perspective. It's going to be amazing in terms of its potential to save, reduce government deficits. But overall, absolutely, the health and wellness, that trend is absolutely going to take off. It already is. And the monies that are going to go into it, if you're looking at that sector of stocks or from a development standpoint, it's just starting.
Yeah, and you're going to see a lot more health and wellness companies go public. I mean,
Yep.
we were just talking about it last night. Gold's Gym was one of the top 4 brands in the world.
Yeah.
And that was a private equity play that ended up, selling off and going more in the capital markets. But that's kind of where this is going to go. You guys are going to see a lot of companies, smaller companies, take their companies public, because there's just such a huge driver for that, and the data supporting, the need for a lot of product, whether it's medical device. There's a lot of cool medical devices coming out with technology, which is also obviously in the health and wellness space. So a lot of that cool stuff. So you guys I think we'll see a lot of that kind of penetrating the market over the next, again, through 2030. So kind of keep your eyes out on that there, guys. All right. So let's get to what's really fun. What most of you guys are here for, real estate. So Mike, you want to go as far as you want to go, and then I'll just try not to go too far.
You're going to step all over me on this topic. Yeah, look, I can start it. I mean, in terms of we talked about it. What are the effects of interest rates on for real estate development? They've been the opposite of what you want, right? So valuations have gone up and costs have gone up. The input cost to develop has gone up, and then obviously interest rates from an affordability standpoint, it's all gone in the wrong direction, right? Mortgage rates are high, and real estate valuations have gone up. So is that trend reversing itself? And I would say yes. We're going to see lower interest rates, the ability basically to finance your mortgages at a lower rate. We're going to have a deregulation of the overall environment. So trying to get the costs of construction as low as possible, right, to stimulate development. Trump's a developer, right? So he's going to go right into the regulatory burdens for real estate developers. And then, and that's easy. But some of the problem with that is a lot of these regulations are at the state level.
Yep. Yep.
So if you look at California, for instance, trying to develop in California is unbelievably complex.
Yep.
And the cost of trying to build a home in California is going to be, I don't know, call it double.
You double your just our insurance on one of our homes before we pulled out of California.
Yeah.
I mean, it was unbelievable. I mean, it was like 14,000 for the year when it used to be 3,000 for the year. It's just insane.
So the regulatory environment is going to have to change for sure. But the bigger picture landscape I think for Paradyme, if we just focus on single family and multifamily homes, there's been a real deficit of, I count it 5 to 7 million. I've seen anywhere between 3 to 7 million. I think it's 5 to 7 is the right number. So how do you meet that demand? How do developers like Paradyme meet that demand, right? Are you going to go build a bunch of single family homes? Or are you going to, is the multifamily sector going to be the one that benefits the most? Like our development in Lake Havasu, 108 units, right in Lake Havasu, 2 to 4 bedroom units, over on an 18-acre site. Now, that's not dense because we've reduced the density of that from 160 units down to about 108, right? But, from a density standpoint, the multifamily, whether it's an apartment or condos or townhomes, or for me, that's going to go a long way if we can get that part of the economy humming again, because it's cheaper to build. And I think you can speak to this better than I can in terms of the cost to build and the inputs and moving from stick build to what we do, right?
Yep.
A metal build and squeezing out the production costs, and we can talk about that forever. But for me, it's like when I look at housing, I sort of look at it's almost like the way that we move like telephone conversations on these stupid telephone poles, right? We were putting telephone poles up, when in Edison's day, and we're making homes almost the same way that we made them, from log cabin days, right? So there was going to be this massive change in the way that builders like us, manufacture, whether it's a single family home or whether it's, apartment buildings or townhome. So I think we're on the cusp of some real interesting developments that can very quickly catch up on that supply and demand imbalance.
Yeah, and so hope everybody's going to record this one because I don't want to tee off too far. But really, the whole point to for what we do, being in the development, wearing the development hat. So I have 2 different hats, right? So I have the hat in which I cut my teeth in the space, which is more of a lender's hat. Now we manage a fund and we have kind of this risk adverse focus of which assets are we going to lend money on. And if we have to lend money to somebody and they fail, we have to take it back, how much energy that's going to take. And how do we oversee the project as we are allowing it to be developed on our balance sheet? That's one hat. So there's a little bit more of I would say, and this is important, there's a little bit more care there because you have investors that you're representing on lending this money out, making sure that they're getting their interest but not lose money as well. But you have to make sure that you are also understanding the scope of work that developer is putting into that space. And this is where I think a lot of people don't know why we are so big and we can do multi-million-dollar, $100 million projects. It's simply because we understand construction material and bottlenecks more than most. How does that have a direct effect on this overall webinar? Well, stocks, bonds, mutual funds, interest rates, economy, it all has a direct effect, not only on you and your financial, your wallet, but how every business is really ran. And so from a real estate side, for what we do, I'm really big, and this is my main focus, is really the lifestyle trends. And what I mean by that is we, you hear, the largest generation, the baby boomers are handing over the wealth to their millennial kids, right? So this huge transfer of wealth. So understanding your end buyer. So if I'm developing a home, who's going to buy this? What's their affordability? What's the economy look like? And when you're developing projects that take 4 to 5 years, you want to be conservative in your pro forma, in your outlook, in your structure, because you really don't know what's going to be like. So you want to try to stay in a space in your head where that you're constantly pivoting and trying to save money and trying to be more effective and basically deliver better for less. That's the rule of thumb. So how does, investments have a direct play on this? What do returns are investors looking for? How do certain materials have, it can become an issue if we're relying on trade or other countries to produce that material? Those are the things that we're paying attention to, all the way down to manufacturing, right? And we'll go on to that on maybe on another webinar. But we're getting into the more of manufacturing our homes. And really the idea behind manufacturing is, if we can manufacture a lot of our own products, we can compress our costs. Therefore, we can do this in volume. So going back to what I said before, if you could do stuff in volume where your costs are low, you could feed the masses, the likelihood of success goes up. So if we're able to control time, cost, and material, you're starting to have more of a monopoly. And that's what I think you're seeing, is this kind of vertically integrated firms that not only from a real estate side, that it's really structured like private equity like we have, but just for the most part, any other private equity structured firm. And we always talk about how private equity is the fastest growing sector inside finance. So you're starting to see people utilize technology, software, other practices to bring down their costs. And that's ultimately what you're going to see in real estate moving forward. But and this is one of the things that I've been coaching people on, because I do coach other, other developers or people who are scaling their businesses, is, what are the key factors to pay attention to? One is being, always trying to deliver a better product for less. That's number one. Value engineer your budget all the time. Two, how are you able to time, speed is absolutely everything. The speed in which you deliver that product is huge, because speed and money, it all kind of pollinates. And that can also help you mitigate risk if you're faster at developing projects, because you can have a shorter forecast on what the economy can do. And now, if I know in 1 year where the market's going to be, I think we can all be honest and say, well, we're not sure exactly where it's going to be in 4 years. So you want to try to deliver, a better product inside that, a shorter time frame. But that's what you're going to see, is that with what happened during the pandemic and how fast things have changed from, Zoom meetings now, and people not, more working from home, and just kind of overall, I think we all can agree that the world has just shifted so quickly that if you look at, and I used this as an example 2 days ago with my team, I said, if you look at what's gone on before the election, how much energy was being pushed in by all of the administrations traveling and speaking and all the marketing and all these. They were not sleeping. It was 7 days a week working. I mean, I don't think half these people slept.
No.
And at the end of the day, that's kind of the takeaway. It's like, that means that the economy is going to shift that quickly. So in your mind, you have to understand that if everything's moving that quickly, you need to move that quickly to have an operating, good, healthy business. Especially if you're trying to grow it, you need to operate from a different level. With that said, because the world is shifting so quickly, you need to understand who's going to be managing that money. So if you have millennials now going to manage the money, they're going to have certain lifestyle trends that they're going to start investing into. It's the same concept as, the people are having less kids, they're having kids maybe later in life. People aren't getting married. Like, that's all real data. And what does all that mean? Right. So you want to be able to track all of that to be able to make the right decisions, not only in investment, but that does have a heavy impact on real estate. And so, for example, Lake Havasu, because it is such a retirement driven area, you can look at the income levels that are coming out to that area. And then you can build according to that. And what most people would do in the baby boomer sector is say, look, I've worked 30, 35, 40 years for the wealth that I've created. I want to enjoy my life, bring down my taxes, bring down my overhead, focus on healthcare, but enjoy my life and be around my grandkids. That's the number one conversation. So they're going to move to areas like this. So it's about demand, right? So it's always about understanding your investments and what the demand is, to be able to know that that investment is probably on the right track. So real estate is all the same thing. Real estate ultimately has, and I've been speaking on it too, even further, is how I believe that politics have a bigger impact on investments than they've ever had in this marketplace. Like,
yes, from a migration perspective.
Yeah, it's
absolutely
unreal. So I think real estate, is of course that's our bread and butter. But I think to understand where to get involved, if you're looking to invest, if you are a real estate agent looking to start flipping properties, make sure you're like, for example, like, we always put Nest, thermostats inside. It's like little devil in the details that you want to put inside these homes, because who's going to end up occupying them. So those are the I say aspects of real estate, the technology, every single, my washers and dryers are on Bluetooth. I mean, you got to implement all that technology. Again, the world's moving quickly. So every asset class is going to make moves quickly. You got to just ultimately be in that space.
I think that sort of hits on what the U.S. does really well is technology. So, again, going back to my analogy, what technologies are going to be applied to either the manufacturing of homes or what's inside of a home? We're having smart homes, right? So that technology input is going to be tremendously, I think, impactful.
Agree.
And touching on it again, and what Paradyme and what you focused on, I think day in and day out is let's really pay attention to the migration trends and the valuations of those markets where migration is tending to go to. So from California out to Havasu, or California to other parts of the Southwest, or here in Tennessee. How many people and from California has moved to Tennessee, and New York has moved down to Florida? So those migration trends are incredibly important and will drive valuations across the U.S. But and then for builders, it's how much land is available, what's the cost, how do we basically change our production? If the cost of land is higher, we have to squeeze out costs of out of production to get to a price point that is palatable for the buyers in that area, right? So that forces technology, and that forces change. And Paradyme, you're touching on it. We won't go into it thoroughly, but what we want to be able to do is control as much of the supply chain as we possibly can. If we can deliver a product faster, more consistently, and with a quality that we completely understand because we've manufactured it, and those inputs go into our buildings, whether it's storage or barn caves. Remember, we're a cement and steel builder, right? So that those are production inputs that we can produce in our home markets with a few $1 million worth of investments, and have raw materials come out one end and finished goods come out the next, which get shipped to our construction site.
There's nothing worse than calling your supplier and go, hey, when are you going to deliver this building? And they're like, well, we don't really know.
Yeah, right.
That really is not comfortable, because you have people who want to buy and move in, and you need to be able to give them a date so they can maneuver their lives around.
Yeah.
And that's where I think you're starting to see a lot of frustration, where again, a lot of operators are getting smart, going, look, you know what? I'll just start mitigating that by doing it ourselves.
Yeah.
And that's ultimately what we're doing.
Because and when you're doing that, going back to this sort of idea that you can have, whether it's a subway with no employees, or a steel manufacturing steel framing that goes in our brine caves, with basically steel coming in one side and out the other with a machine that's automated and stacking it and putting it on our trucks. All that can happen with very little labor. So then it becomes, what are your costs? Your costs are your technology and the power to drive it all. And even on that front, I think the U.S. is going to do an incredible job, basically, of diversifying those power inputs and the power costs. All we've seen through the last sort of few administrations is to try to increase the power input costs so we can migrate to green energy or whatever, right? But we all know that if we're gonna resource and onshore manufacturing, those are power.
It's a lot of power.
It's a lot of power that we're going to need, whether it's nuclear, oil and gas, nat gas. Those are the most efficient power sources.
All the way down to food and more cold storage, which is a big push right now, by the way.
Right. Yep. So you've got to get your energy inputs lower. And Trump, that's one thing that he said, absolutely, we're going to get our energy costs lower, because lower energy costs, access to energy, basically, to a great extent, has driven success, and it's driven net worth, and it's driven innovation. It comes down to those inputs, right? You don't want to be burning wood when you've got a nat gas source for power, and so the thinking about scale, that's really important, right? So scale, input costs are important to the manufacturing process and in creating overall wealth, because it drives innovation and change, right?
It really does. Okay, we're going to get close to wrapping this up here, guys. So let's talk a little bit about, let me grab, oh, there we go. The diversification model that we were talking about a little bit in the past here, guys. And of course, our webinar also wants to kind of give you guys a better, deeper dive of what we do, give you guys opportunity if you are seriously willing to and interested to invest, but also kind of give you an idea why we're structured the way we're structured. So these two offerings that you guys see is a secured income fund, which Mike talked about, the Q3 update that we provide to our investors. That is when we call it a secured income fund, it's basically an investment where we're lending money on short-term bridge loans, fix and flips, ground-up construction, non-owner occupied, business purpose loans. Everybody has to own an entity, an LLC. And these are just to get in, get out, renovate homes, and get out and make some good coin. So they don't have to, the borrower doesn't have to go through, a bank and the scrutiny for it. And normally these homes are in pretty bad condition. So therefore they're not financeable through a bank line anyways. So you go to guys like us, that'll be the same method. We operate like a bank, but we charge a little bit higher interest rates. We get in, get out, and we do lower leverage. So our loan to values on the property are a lot lower as well. So that is what we call our debt piece or our debt fund, which a lot of investors like. So for those of you that have a wealth manager or understand the wealth management models, a lot of investors, they say, look, don't put all your eggs in one basket. I totally agree. But you want to do, when there's a volatile market, you typically go more into the debt space because it's typically a little more of a safer investment. And then, X amount of your percentage of your net worth or liquidity goes into equities. The secured income fund, which is why we actually brought Rev on as our portfolio manager 2 years ago, and obviously migrated into CEO, but is really to oversee that because there is a lot of moving pieces, but because he understands the institutional world, it's structured like an institution. Again, we fund loans and we sell notes. There's actually a secondary market to buy these because of the nature and how we underwrite. So going back to what I was saying before, having that underwrite and wearing that one hat, right? Underwrite, I'm literally I do nothing but poke holes in it, right? And into every project that comes across my desk for funding. Where back in the day, as a loan officer, you just want to fund the deal and get your commission. Let's be real, right? When you're a fund manager trying to protect your investors' money, you look at things with like, where's the landmines? Is this, borrower lying? Have they done this before in the past? How much money do they have? Let's talk, you want to get appraisals done sometimes too.
Mm-hmm.
We require all kinds of different things to verify that the asset's a good one for us to lend money on. So that is a very consistent return profile, meaning investors are making 10% consistently a year. We've had it running since 21. We've had consistently dividends paid out every quarter, and investors love that. So it's kind of like a safe haven.
It's boring.
It's boring.
Yeah, consistent.
It's boring.
It's boring, but very, very consistent, right? It's you put your money aside. It's liquid. Yeah, we're effectively a bank, as Ryan said, and we basically we lend money, and in the other end, we basically paid a preferred distribution of 10% per year now. So it is the boring part of what we do, but what I like to say is the deeper you dig into it, the more exciting it does get, because we're able, without going into it, people can call me, as an aside, we could take you through how we manage the balance sheet and the risk, but we have the ability to lay off our risk within the portfolio and then go on and redeploy our capital. In doing so, we can build up a multiple of our equity or assets under management and have assets feeding into the fund that are non-recourse to the fund. And it's an amazing advantage that, I think we don't talk about as much as we probably should. But in the other part of this, I think too, is we've been able to sort of put through a very consistent 10% per annum return in a very challenging market, right? So it's with interest rate shifting and housing slowing, fix and flip market, slowing down probably 85%.
Yep, at one point, yeah.
Yeah, so we've been able to develop and sort of push through that with our lending practices in the secured income fund. But I think, given our outlook, I would expect the fix and flip market, to really take off over the next 4 years. And with that, I think the turnover within this fund and how we deploy our assets and how we manage our risks is going to. I think we're really set. We got a tailwind at our backs with this secured income fund.
Yeah, and if you look at the way we produced returns when we first launched in 21 to 22, 23, 24, we went from 7.5 to 8.5 to 10%, stayed consistent. We're even showing better balance sheets now, and it was really set up in a way where it's kind of a distressed asset fund mindset. Again, that kind of what if. It's not a matter of if, it's when, right? So that fund, we love it so much because during a good market, and let's just say right during the pandemic or 2021 when the market was booming, we were crushing it too. Tons of note buyers out there, ton of money in the market, ton of institutional buyers buying our notes. It was great. When the market shifted, we moved all of those, instead of funding a lot of loans, we had a break between how much we want to sell and how much we want to keep on our balance sheet, because as interest rates go up, we get to ride those waves. So now we can be more strategic on which loans we're going to lend money out. We can be in more higher demand areas, better asset classes, maybe lower leverage. The kind of the list goes on, but now we're charging a higher interest rate and getting the yield, and therefore we can kind of ride the wave. And there was a time where our balance sheet was so sexy that we didn't have to lend money to survive, right? And again, the firm, which is huge for you to know, is the firm has multiple revenue streams, which creates stability. If we only had one fund and that was our business model, a lot of times investors get a little more nervous because they're going, well, what happens if the market fails on that one particular strategy? And that is a good question. If we're talking about, telling our investors about diversification, we're obviously living that too, right? So again, that SIF is a really, really cool model. And again, it's more, we have investors that are putting money in there and then taking it out, buying homes, then coming back, and, but it's a very consistent model. Most of our investors do like to be in it and stick with it, just get the cash flow, but they have the ability to get their hands on it. And it is more of a liquid fund because, again, it is short-term bridge loans. So it's a much more stable investment. Again, debt. And then moving over to barn caves, which everyone knows about the barn caves, and that is morphing into be an unbelievable product. And we'll, without going too far into it, I'll just make the bullet points. What we're doing is we're raising capital from accredited and non-accredited, where non-accredited investors, typically firms like ours, are only raising money with accredited investors, meaning you got to be wealthy to party. And we're not doing that. We are opening up for everybody. So therefore, we had to go to the SEC, explain our business model. They had to, in essence, approve it, and then allow us to go out and solicit to raise the capital and build awareness like we are here. However, what's nice is now those smaller investors that want to get into what the big boys are doing can now be in the same boat with the same row. And now they can participate in commercial real estate and really get those returns and start building that wealth that everybody's really wanting to build, right? The Barn Caves is an 18-acre site right here in Lake Havasu, which is great because we're already building another $100 million in projects in Havasu, right next to Paradyme Storage on the north side, right next to 720,000 square feet of retail, which includes the Home Depot and the whole mall and Dillard's and JCPenney and Walmart. And, on the other side of the highway, you have an airport. So, location is key. And then really what we're building is something that's very innovative. It's actually a fully steel building that's designed like a barn dominium. And it's a 3-story higher dense product. So now we can kind of build something that's more affordable. And in fact, that's really why we're getting so much support, because the city doesn't have a lot of affordable homes. And when I say affordable, attainable, not low income homes. Okay. Again, we're building something very nice for cheap, and it's utilizing these practices to be able to deliver that. And that's why the city is really supporting this. For those of you that are on this webinar that are from the city of Lake Havasu, I want to say it was August or September, your power bill went through the roof. It doubled, right? Maybe even more. Well, that actually, we found out about it doubling at 10 o'clock on the day it doubled. We were in the city having basically a pre-construction meeting regarding this project. And what I'm lining up is this entire project will have solar, and therefore even our unit owners have access to that power savings, which is anywhere between 68 and 70% of your power bill every month, which is awesome because you're probably going to have 4 air conditioning units given the size of the garages. But what's going to happen is we're going to produce so much power, 10,000 panels plus for this entire site. And we're actually going to give more power back to the city than what we're pulling. So as you can imagine, the jurisdiction, which is Unisource out there, is going, wait, hold on. You're telling us that you don't have to pull from our grid and you're going to give us power? Like, yeah, let's wave our hands to approve this thing, right? That's really what's happening. So at the end of the day, the way that we look at it is, if it's good for, the city, if it's good for the community, if it's good for our investors, if it's what's needed, if you're looking at the demand and you get all the data, then the likelihood of the investment to go well goes up. Now it's really about us building and delivering. Therefore, now honing in on the construction, bottlenecks in material, manufacturing, certain things that we're implementing that is really going to take this to the next level. But really what the innovation of it is that it's a 3-story product with a huge open second to third floor space. Think of a 3rd floor master suite where you have your master upstairs and your 2nd to 3rd floor is all open. So you only half of the building is built out, the length of the building for the 3rd floor. So for your 2nd to 3rd is all, it's like a 26-foot vaulted ceiling. So it's just very open. Nothing that Lake Havasu's ever seen before. What's nice is I've seen a lot of this product throughout the country. So I'm ultimately, what we're doing is we're just taking our track record and our experience and kind of marrying it up to trying to bring down the cost and build something really desirable. But that's ultimately what we're doing here. And the returns on that are 31.5% our projection. It's a 4-year investment. Minimum investment's $2,500. If you're accredited and you want to party with the wealthy, then the minimum's $50,000. And we have investors that invest a whole lot more, so we can have that conversation if you guys are interested. But that's one of the things that we're really focusing on, again, is the debt and the equity, right? Debt, less risk, more stable cash flow, not big upside though, where the barn caves, more risk, more reward. Therefore, you have a bigger upside. Where we can dive into, and we don't want to bore you on this webinar, is really the structure of that project and getting into the weeds with you if you're interested on how we're financially creating the capital stack to make it work and how we're migrating labor issues and trade issues. We can dive into the weeds with that. But, going back and summing up on this, and I'll let you have it, is we are also building a community center. So this is really kind of a mixed use product where you have high dense residential, 3 stories, tall skinnies, and then you have a retail gym that's open to the public that generates cash flow. However, the residential has access to that as a community center, but you don't have to get billed through the HOAs on having a pool and a community center and a little gym. The HOA costs are very, very low. So we're very strategic on how we are adding value to our end users by not having a big overhead. And again, trying to bring down the cost of maintenance is a big deal too for, again, our end users, power, what have you. So that's kind of the 2 offerings that we have here, guys. And so if anybody's interested further, let me or Mike know. We'll jump on and talk till we're blue in the face.
Yeah, I think just when I look at those 2 offerings, I think consistency, right? We talked security income fund, yeah, boring, but even what the Paradyme development brings to that is we have the ability, if there is an issue with one of the properties, to come in and take it over and then bring it back to the market and sell it. So there's embedded upside even in the security income fund, which makes it sexier than we even advertise. And the barn caves, when I look at the barn caves project, I see consistency as well, right? So the trade-off when you're an investor is when you're putting money to work, you're making an expectation for, I'm going to put $1 to work, and I think it's going to make X, over some time period, right? And then what's the uncertainty? What's the volatility of that return over that time period? And you may not know you're doing that, but that's exactly what you're doing when you make an investment. So what people undervalue is the certainty of getting to that expected return. And if you're a developer like Paradyme is in the barn cave, so it's absolutely defined. We can define every aspect of from purchasing the land to delivering the final units. And all of those steps, we can provide granularity. It's 100% certain. So what are those, right? So as the risk of developing a barn cave project or investing with Paradyme is Paradyme as a developer, can we do it? Number one, right? Paradyme's developing almost 1 million square feet now across the U.S. So as a developer, we've proven ourselves, our chops are there, right? Then it becomes, are your pro formas correctly? Like, are your pro formas correct? Are you undervaluing the cost to take that to market or not, right? And I think if anything, you look under our hood, anybody who spends time with a number, we are overestimating expenses, underestimating our ability to bring it below, even with the manufacturing that we're doing right now, which could potentially reduce costs by up to 30% for some of our major inputs, right? So, and then you go all the way to the demand. So what, ultimately, do you have a sense of what the demand's going to be at the price point that you're going to bring this to market? And, when we essentially closed on the land, we had 150 people come out and put their name on the
we
list
did.
to buy one?
That was just our existing network, but no,
Yeah.
Eric put
the 300
we
plus.
put it on the front page of the News Herald, and
Right.
we had like 250 inquiries or something like that in 24 hours.
Crazy.
Yeah, it was wild.
Crazy.
Yeah.
And so, I think from a demand perspective, it's nice that this first one is in our own backyard. We know that market really well. We've got the biggest broker that is sort of looking after the demand side. He basically said to you, stop advertising. This is your way, don't even bother with advertising. You've got the buyers. at the price points that you want to bring this to. So
In all fairness, and I don't mean to cut you off, Mike,
yeah.
I mean, it's morphed into a point now where we're getting so much interest throughout the country. That's what's actually sparked us to want to go into manufacture these. So what's happening is we're thinking about building these in a manner and volume where other people can buy these buildings from us and pop them up into other lots around the country. And really it's designed in a manner where, since we came from California, we understand the building codes. And so if we, all the way down to fire protection and build these things in a manner where you can get regular insurance, like a regular single family home, which is exactly what it is, you can go to more institutionalized. So now people that have, developers that want to build, 50 of them, 100 of them downtown Nashville, as an example, we can deliver this in a whole lot. The timelines change significantly in the way we develop this product. So now we're looking at larger institutions that want to finance this stuff, that want to get developers out there to just pump these units out and get more support with private-public partnerships. And now you're getting more government funding, backing, and support across the board. So, one of the things for you guys to know is that the architect of record that's helping us develop this is actually the architect that remodeled the Pentagon through 9/11, a $1.4 billion budget. And he said it was a lot more than that. But yeah, so
Sure.
but it was a really pretty, it's a really cool product overall. But yeah, we have a lot of really cool moving pieces to this particular development.
Yeah. So going back to it, it's consistency. So can you define the parameters of the investment and what's the probability of delivering upon the pro formas that we're putting out there? And I would say very, very, very high. So then you go back to say, okay, well, that's 31.5% a year. What are other assets? What are my alternatives basically to that? What's going to outperform that investment? And with the certainty or that standard deviation of returns around that 31.5%, I think very few asset classes are going to do that. I don't see stocks outperforming the Barn Cave project. I don't see, look, Bitcoin's at 100,000. That would be in 4 years, Bitcoin would have to be trading at 220,000 to break even with the Barn Caves, right? So, everything's going to have to go 2.2x to outperform that project. And I can tell you the volatility around a Bitcoin return is going to be very high, and the volatility around a Barn Caves return is going to be very low. So I like certainty, right? So if I can define what the outcome is with a high degree of certainty, then I'm going to invest in that. So, and when I talk to investors, that's really what I'm telling them. It's like, go ahead, you're gonna lock your money in for 4 years on this one, but that's a good thing.
No.
Because you don't have to reinvest that capital every year and try to hit 31.5%. You don't put whatever you can afford to put away and just ride this wave over the next 4 years, and don't worry about it. Just set it aside, and we'll be fine. So consistency, I think, is what we aim really across the platform, and that's what we're delivering for investors.
Perfect. And that's it for me.
Yep, it for me.
We're good. Thank you guys. I really appreciate it. Sorry, we went over a little over, but hey, knowledge is power. So hopefully we brought some value, and thank you all. And we will send you guys this email as well with the recording. And then if anybody has any questions, feel free to respond. Book a time with either me or Mike. We'll jump in and dive in and, any of our projects or what have you. But we are honored to have you here. Thank you very much for your support, and we'll see you guys soon.